Today, my guest is Nick Aiola. Nick is with IolaCPA.com, and they specialize in tax services for real estate investors. And today, we're going to speak with Nick about the tax benefits of real estate. But first, I want to remind you, if you like the show, CREPN Radio, please let us know. You can like, share, and subscribe. Also, you can leave a comment, and we would love to hear from you. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel, and that's at Commercial Real Estate Pro Network. With that, I want to welcome my guest, Nick. Welcome to CREPN Radio.
Thanks, Darren. Thanks for having me.
Well, I'm looking forward to speaking with you today and getting into our topic. Before we do, if you could take just a quick minute and share with the listeners a little bit about your background.
Sure, absolutely. As you mentioned, I'm a CPA and I run a virtual CPA firm, Aiola CPA, and we cater to real estate investors. We focus on tax planning and strategizing and tax preparation for real estate investors. We're very specialized in real estate. I grew up in real estate myself. Personally, I invest. I do own a few rental properties, and it just made sense to kind of segregate on one area of the tax code that we know and we can provide exceptional value to people just like us who do it as well.
Got it. Well, that's great. And just curious, being virtual, I assume that means you can provide your services to anybody in the U.S., or is that right?
Yep, that's true. We're across all state lines, so we can operate nationwide.
Got it. Well, I am looking forward to our talk today. And as we discussed a little bit before we got started, just the kind of the broad nature of tax and the benefits that are associated with real estate. But I think that for today, and I think our listeners will appreciate this, is just a kind of a look, kind of a more of a finite look at the difference between how different types of investors are treated for tax. And so with that, I was wondering if maybe we shouldn't start with kind of defining the different types of investors.
Yeah, absolutely. And as we know, that in real estate investing is a tax advantage sector of investing. The tax benefits and advantages are far and wide. But as you said, there are different kind of classes, we like to say, as of investors. The most broad we're talking about is passive versus non-passive. That goes for the type of investor you are and the type of income that these investments are generating. So passive and non-passive, or people like to call non-passive active income, it's just two different verticals, and they have two very different tax implications. So mainly these apply to, let's say, landlords and how these are treated. And to give you an example, passive income would be rental income, from if you're a landlord and you have, you rent out a property to a tenant, or you passively invest in a syndication. These are all those are examples of passive income. Non-passive, active, earned income, however you want to define it, is more like flips. If you're doing flips, wholesaling, if you're a real estate agent, that's all active businesses, and that generates non-passive income. So the difference is really, from a very broad term, tax-wise, is how you can treat losses generated from these kind of activities, whether it's passive or non-passive, and whether the income, if there's net income, is subject to self-employment tax. And self-employment tax is just around 15%. So it's not a small amount to, if you're doing your tax calculations, to just gloss over. And that's what you run into when you have active income. Flipping income and wholesaling income, that's subject to self-employment tax on top of ordinary income tax. Whereas passive income, you don't have to worry about self-employment tax. On the flip side, when you have passive losses, you can't really use those losses to offset non-passive income, except for a few circumstances. So in very broad strokes, there are pretty substantial differences.
So if we could back up just one second on the distinction on the active, I understand the flipping or the wholesaling, where that's kind of more of a transactional uh, nature. What about the person who's actively managing their own rentals, collecting rents, dealing with tenants, that type of thing? Do they qualify as active?
Sure. So rental activity and income by nature is passive. Within that scope of landlording, you have kind of subcategories. So you have passive activity with active participation, which is different from material participation. And you can see how it quickly gets complicated. You can be completely passive, being a hands-off investor where maybe you funded the deal and you're not really managing the rentals. You have no management or active participation in it at all, and that's completely passive. However, there's, like I said, a subcategory that's called, passive with active participation. It's rental activity with active participation. What that means is it's pretty literal. You actively participate in the day-to-day activities, even if it's just managing the rental. And that's where you kind of free up some of these different tax laws. So very broad overview, passive losses can only offset passive income. Net passive, if you have passive losses from one activity and passive income from another activity, they can offset each other. But if you have just passive losses from one activity, that can't offset non-passive income like a W-2 or a side business that you're active in, or portfolio income like interest, dividends. So it's important to know the difference between how passive losses are treated. And where we really see this difference is that active participation. If you actively participate, so if you are a landlord and you're managing your rental property, or even if you're managing the property manager who's managing your rental property and you're active in that business, so to speak, you have a little more flexibility of what you can deduct in terms of losses. The law is that you can deduct up to $25,000 of net passive losses, rental losses, in excess of passive income. And the stipulation is your modified AGI, adjusted gross income, has to be less than $100,000. So if your modified adjusted gross income is less than $100,000, you can deduct up to $25,000 of rental losses, net rental losses, against non-passive income. So your W-2 or any other income that's not passive. Go ahead.
No, go ahead, and
Sure. So once your modified AGI exceeds that $100,000 threshold, that $25,000 allowable deductible loss starts to phase out and become less and less and less until you hit $150,000 of modified adjusted gross income, at which point you can no longer deduct any rental losses in excess of passive income.
Okay, so let's back up there just a second. So the losses, I think one of the things that gets talked about so much with real estate is the ability to show paper losses, and I think the majority of those, I would say, come from either depreciation. Is that not where that
That's
comes from?
accurate. Yep,
Okay.
that's correct.
So if I have if my income exceeds 150 and I'm participating in as a passive investor in a real estate investment, and I get my K1 and there's income and depreciation, um, in the so if the income exceeds that depreciation or the loss, then I've got to pay tax on that income. Is that correct?
Yeah,
On
if you have
that
net rental
overage?
income, you'll be paying tax at your ordinary income rates. If the net effect is income in excess of depreciation, that'll have a tax impact.
Okay, but if my losses exceed the income, so let's just say that you've got a $75,000 loss, but a $50,000 income.
Passive income or non-passive income?
Well, let's say passive to begin with.
Okay.
So that $25,000 loss, I don't get to I mean, the difference between that 50,000 income and the $75,000 loss,
Right.
that $25,000 I cannot use against my W-2 income. Is that right? Or
If
is it
your
just
income exceeds if your modified adjusted gross income exceeds 150,000, that's correct. You can't use those losses. You don't lose the losses; they just carry over to future years. So,
okay? And
you know,
that's what I wanted to make certain we touched on is the carryover,
right,
because I think that sometimes when people go, oh, well, it won't help me, kind of thing, because it,
right.
of their situation. And maybe we can uh, well, let's talk about how does it work if you are active, as opposed to, we just talked about the passive. Is it the same
Sure.
threshold?
Sure. So if you have active participation, you're subject to the same threshold, but you can deduct. Like I said, if your income is below that $100,000 mark, you would be able to deduct that full $25,000 amount. And as you exceed that $100,000 threshold, that $25,000 limit decreases and phases out until you hit the 150. So the only other way to be able to deduct those losses, those net passive losses, if your income exceeds 150,000, is if you are a real estate professional. And this is if assuming you don't have any other passive income to use the losses to offset it against, is if you're qualify as a real estate professional, which effectively, for tax purposes, turns the passive income classification to active income, and you can deduct those losses against any other kind of income, passive or non-passive.
Okay, and just to make sure I understood right, so if I'm real estate professional, I can write off all my losses against all my income,
With no limitation.
no limitation. Okay. If I'm not a professional, my losses are limited to, say,
Your rental your rental
okay,
losses will be limited to $25,000 in excess of any other passive income, assuming you meet the income thresholds.
okay, and then that again gets challenged, or the measured by the adjusted gross income,
Right.
right? As far as the max on that. Okay.
Absolutely. Yep.
Okay. All right. So let's talk about the carryover of that. So we had a great year. There was well, I say a great year. There was some big paper losses. We made some money, but we also have some big paper losses. Based on the scenario we just described, the losses are not able to be recognized. So how are those treated?
So, assuming that to be true, that the law you cannot deduct the losses in the year in question, they would carry over to future years, and we call them suspended passive losses. So these losses are suspended and carried over to future years indefinitely, and there's no limitation on the amount that's being carried over. And they can be used in future years to offset future passive income. For example, if in year one you had these substantial paper losses, and in year two you had substantial income, taxable income, you can use the losses from the prior year or years to offset the current year passive income. That's one way to use them. Another way to use them would be if you sold a property and you had some capital gain as a result of the sale. Once you sell a property, that frees up the suspended passive losses, and you can use those losses to offset a portion of the gain. They're reported on separate lines on the tax return, but the net effect is that it's offset.
Okay. So you mentioned sale of a property, and I was looking around on your website last night just to try and kind of get a feel for some of the articles and stuff you've written, and there was a couple on there that kind of touched on this topic, and I recommend anybody listening to check it out. Um, but the one was the flip side of depreciation, which is the depreciation recapture.
Right.
And what you just mentioned was on the sale, you've got a capital gain. And maybe just real quick, we kind of establish, just a basic numbers kind of thing, so we can get a feel for how that's treated. So I think in the on your page there, you had some sort of a property. Let's say it was a $300,000 purchase, um, and there's 80% of that's uh, structure, which is you could depreciate in roughly, $3,000 a year. So if you keep it for, and then that's at 27 and a half years. So, I think I don't know if my math is right here, but
Yeah, I don't
roughly,
remember the exact numbers.
yeah,
I'd have
yeah,
to,
but
right.
the example, essentially what we're trying to say is if you keep it, and again, capital gain is something you keep for longer than a year, correct?
Well,
So,
capital gains, you can have capital gains if you sell it within a year. It's just short versus long-term capital gains. So
okay,
short-term capital gains, or if you sell it at a profit, at a gain under a year, it's taxed at ordinary rates. Long-term capital gains, or if you sell it after a year, after you held it for a year, and that's taxed at preferential long-term capital gain rates.
okay. So for this example, let's just assume that you've held it over a year. So we're dealing with long-term capital gains. Um, So we have a gain, which is essentially the sale price less our basis, and our basis is determined by our acquisition cost less the depreciation we've taken. Is that right?
Right. Plus
Or
any
the accumulate.
improvements, if you
Okay,
made improvements to it. Yeah.
okay. So you start with X, you subtract out however many years of depreciation, add back in any capital improvements. You've got a number. There's a delta there. There's a spread between the sale price and your basis, right?
Right.
So now is the gain calculated from your original acquisition price, or is it because there's also the depreciation recapture?
Yeah. So
Um,
the depreciation recapture, also called the unrecaptured Section 1250 gain, is basically you have in that example. And again, I don't remember the exact numbers I used in the article, but if you are depreciating a property over time, you buy a property for X amount over time, that's being depreciated year after year, and which reduces your basis. So when you sell that property, portion of depreciation that you've claimed since you purchased it has to be quote unquote recaptured and taxed at a different rate. So if you have a gain on the sale of a property after doing the computation we just went through, um, you would apply the portion of the gain first to that depreciation recapture, which is taxed at 25%. And then anything in excess of that depreciation recapture amount will be taxed at either whatever it is. If it's a long-term gain, it would be taxed. Most people fall into the 15% long-term capital gain tax rate.
Got it. And the depreciation recapture tax rate is it 25%? Is that
25, right?
okay? And just again to kind of you know restate the conversation. So if we've taken over the course of X number of years, let's say we've taken $10,000 in depreciation, just to keep it simple. Essentially, the tax against that would be the 25% or $2,500. Is that
Correct.
okay? And then if
Assuming
that
there's enough gain, yeah. Assuming that the gain exceeds that amount, yep.
right. No, so we bought for X and we sold for X plus.
Yes,
So we recapture because again we can't show. Yeah, and again I think the your article there was gave multiple examples in case you sold at a loss or sold at equal and
sure.
kind of like so. But assuming we sell at a number higher than what we purchased and our basis is, um, then we have a long-term capital gain. But the first tax, I guess this is something I hadn't really understood the mechanics of. The first look at is the depreciation recapture, and then the balance of the gain would be the long-term capital gain, presuming you
Right.
kept for longer than a year.
Exactly.
Okay.
Yeah. And that's a surprise that we see. A lot of investors don't necessarily know about that rule. And if you're expecting to pay 15%, and these are all federal rates, and this is not including any state tax rates or city local tax rates, just for simplicity's sake. But for federal rates, if you're expecting a 15% long-term capital gains tax on your entire profit, and you see you've held the property for a while and you have a 25% tax rate on all this unrecaptured, this depreciation recapture, it's an unwelcome surprise, as you can imagine, in a lot of cases. So it's important to educate investors about this, because almost every landlord, I mean, depreciation is not an option. It's a requirement. Even if you haven't been taking it on your tax returns erroneously, if you haven't calculated basis correctly, or if you haven't been reporting depreciation expense, upon a sale, the IRS is still going to treat it as if you did. They're still going to, calculate that depreciation recapture and make you recapture that depreciation, whether you took it or not. So it's important to know I wouldn't call it a con or a downside, but just something to be aware of when you're selling rental property.
Right. And I think that the significance of this conversation for me is just that recognition of, just I guess the mystery, or what is depreciation. The whole nature of it is designed to, and correct me if I'm wrong, but it recognizes that the building has capital requirements. There are elements of the building that are going to wear out over time, and so that in an effort to, I guess, help the property owner maintain their property so it's a desirable property, there's an allowance for a recognition of these expenses that naturally occur.
That's correct. Yeah, what the IRS does is they assign what's called a useful life to all these different asset classes and different assets. And for whatever reason, the determined asset class for residential rental property is 27 and a half years. So when you buy a rental property, whether you purchase it in all cash or whether you're using leverage and putting a down payment, or you're using 100% of other people's money, you're not getting any deduction for that cash outlay, or that I don't really want to call it an expense, but that purchase in the year you buy the property. So what they're doing is, you're saying you bought this asset and over time it's depreciating, and you're recognizing a portion of that purchase over time as a deductible expense through depreciation.
Got it. So going back to our sale example, where we have the gain, is there a difference between the passive investor versus the passive with active participation, as far as how they're treated on the net of the sale?
Well, in that instance, it would depend on if they had, I guess, suspended passive losses, because that's where, I guess, it all came into play, is that could you use some passive losses to offset that? If you were completely passive and you, for example, put some money into a syndication as a limited investor, you would have all that detailed on, on the K1. You would have your gain amount, you would have the amount of depreciation recapture. It would be listed on the K1 in the respective boxes. And when you did your personal tax return, you would just import the information from the K1, report it on your personal taxes, and it would be handled that way. If you sold the property, your own property, you were a landlord and you sold your rental property, the tax effect would be the same. It's just, it's not reported via K1, so you would have an actual sale. And then, depreciation recapture would be computed the same way as if it flowed through a K1. It would just be reported a little bit differently.
Got it. And this makes sense, I think, to bring up the alternative to paying the tax right now. If you were looking to reinvest, you could take advantage of the 1031 exchange.
Sure. Yeah. 1031 exchange is a great, useful tool. And that you can basically roll your gain from one property into the next, and you defer taxes on it. And that includes depreciation recapture.
Okay. So the gain plus the depreciation, you can roll into the next property and essentially not have to pay the taxes at that time. And I assume this is presumably it's a long-term approach. Make sense? I mean, as far as
Yeah.
the plan, or the reason to do a 1031.
Yeah, and it is a long-term approach, and we've seen it's a way to scale up easily too without paying any taxes. I mean, you can start out with the littlest investment and grow that into, a multi-unit apartment building, and however big you want to scale it, you can roll, because the whole point of a 1031 exchange is it has to be equal or greater. So you're trading up in value. and you can re-leverage those investments also. And there are you can pull money out of 1031 exchanges. You would have a taxable event there, but in the very broad sense, yes, it's a long-term play, because you keep rolling these tax deferrals into the next one, into the next one, into the next one, and eventually, if you sell, you're going to have a pretty sizable gain, because you started out with that first investment. But as to avoid sounding morbid, the popular, I guess if you want to call it strategy, is to they call it swap till you drop. You keep going and you keep 1031 exchanging and 1031 exchanging until you eventually pass it on to your as an inheritance to your beneficiaries, to your family or whoever else. And at that point, all of the gain that was deferred, all of depreciation recapture, goes away. It steps up to the fair market value at the date of death, and whoever's inheriting this property or properties can sell at that time. If they sell it right away, probably at no gain.
Right, because their basis is what they acquired it at
Right.
on that day, so yeah, no gain. No, and I think that most of the investors that I know that have kind of a long-term strategy, that seems to be kind of their line of thought, which makes sense.
Sure. If the
So
IRS gives you a gift, you take it.
yeah. Don't challenge them on that.
Yeah.
So let me ask you on just backing up here on the 1031. Is there any difference between the passive act or active investor, as how that's treated, or is it
The concept is the same. The concept is the same. It's more about because 1031 exchanges like kind exchanges, so you have to make sure you're exchanging into an investment that's similar in nature to the one you're exchanging out of. So a lot of times syndications don't qualify for 1031 exchanges, because if you're selling a rental property and you're going to roll that gain or the profits or the proceeds into whatever you're going to roll into, if you're going to roll it into a syndication investment, you're not really acquiring an interest in real property. You're acquiring an interest in a partnership, almost like shares of a corporation, for lack of a better term. But basically what you're doing is you're not acquiring an actual piece of the real estate, so it doesn't qualify as an exchange. So in that sense, being truly passive in a syndication, that really wouldn't qualify. But anything else otherwise, as long as it's from real estate to real estate or another similar investment, the 1031 exchange doesn't really, that doesn't play into whether you're passive or passive with active participation. But once you do exchange, the income and losses generated from that new investment, that's when you start to think about the active participation and passive investors, and am I a real estate professional, and then you start having those conversations again.
Got it. In your mind, is there a kind of a hold period where once you've passed a certain point of years, that it makes more sense to do the 1031?
In a general sense, or if you're, let's put it this way.
Just a general sense.
There's no recommended holding period for, when you can do your first 1031 exchange on any kind of property you've had. But we have had conversations with clients, and even in my network in the past, that you have certain clients that want to. It's an exploitable area, right? So certain people do want to exploit this area and say, okay, well, I'm really doing a flip. You can't 1031 exchange a flip because it's considered inventory. It's not a rental property. So they're really doing a flip, but they want to bend the rules, so to speak, and do a 1031 exchange on that flip. And you really can't do that. And if it's a short period of time, we always say that, there's no bright line rule saying you have to hold a property for X amount of time before you can 1031 exchange it. But there are guidelines. The longer you hold it, the better. Definitely, I would say over a year. I would prefer to see it closer to 2 years that you've held a property before you sell it and exchange it. Because if you have a property for 3 months and you go to exchange it, that looks a little fishy. It almost looks like you did flip the property.
Sure. No, and I guess that my line of thinking when I asked the question was more about as a long term. If somebody's held a property a couple of years, that's different than if they've had it for 15 years. based on
Sure.
the accumulated depreciation.
Right.
Is there is there a point at which you would say you really need to do this, as opposed to it's kind of an you still, because it seems
Yeah.
to me that the deeper you get into this thing, you've got all that depreciation. I mean, you could
Okay,
obviously you
yeah,
can have.
I see what you're asking now. Yeah, definitely. It's less about the time you've held it and really more about the numbers, the gain you're talking about,
Okay.
the depreciation you're talking about, because you can hold a $10 million property for a year, and the depreciation you've taken on that property is pretty substantial relative to the cost of completing an exchange. Whereas you can hold a $30,000 property for 3 or 4 years, and still the cost may not, depend on the numbers of what kind of gain you're looking at, what the depreciation recapture is, what the cost of doing the 1031 exchange is, because you're going to have to, you're going to have to work with a qualified intermediary who's going to charge you to complete the exchange, and you're going to have to add, reporting a 1031 exchange on your tax return is not simple, and you'll have to pay a professional do that for you as well. So the cost of doing a 1031 exchange, meeting the timelines, it would have to be weighed against what's our actual tax impact. And we've advised clients on that too. If there's a relatively small tax impact and the cost outweighs the benefit of doing it, it may be better to just pay the tax, take your cash, reinvest it, and go from there.
Got it. I want to ask a kind of a related depreciation question. I know in the syndication world, the topic of cost segregation studies is talked about quite a bit.
Sure.
And as I understand it, maybe you could speak a little bit to it, but cost segregation basically breaks down the building components and then puts them in different buckets, and based on whatever the bucket they're in, you can accelerate the depreciation from the straight line, 27 and a half or 39 to what, 5, 10, and 15, or something along those
Absolutely.
lines. Is that
Yeah, definitely. That's correct. And even with bonus depreciation, you'll even accelerate it even more. Um, that's another analysis we like to do for our clients, and I'm sure other CPAs who are familiar with cost segregation do the same thing. Is you run an analysis and see, at what point does it make sense? Because could you do a cost segregation on a single family home? Yes, you could, but we have that same cost benefit analysis. At what point does it make sense? How much personal property are we extracting from this real property, and how much in accelerated depreciation can we take? And it all goes back to, again, can we even deduct that depreciation? If we accelerate depreciation this much, most likely it's going to result in a paper tax loss, a net tax loss. Can you deduct it? That goes back to, the active versus real estate professional versus passive. So they're all kind of related. But it all comes down to analysis. No one situation is equal to another.
sure? And I guess what my thought process is on this is that if you are a passive investor and you're investing in a syndication, and the syndication is doing a cost segregation study, and the intent of the syndicator is to get in and out in, say, 5 years, right? Um, that accumulated depreciation that you likely haven't been able to, uh, fully take advantage of, would come in handy on the sale when you have that
Correct.
gain from the. So it's not. I guess that's really kind of the distinction or the clarification that's it's become more crystallized in my mind as I've come to understand how all of this interacts. Is that
Right. Yeah, that's true. I mean, if you have front loaded depreciation and you're taking these major depreciation deductions, and then, these losses are suspended to future years, and you only recognize it upon the sale, an argument could be made that did cost segregation really benefit you? Because on the other hand, if you didn't take all this accelerated depreciation, you would have less of a depreciation deduction, but you weren't getting an immediate benefit for it anyway if these losses were being carried over, if you weren't able to use them. And then when you sell, sure, you'd have less passive losses to offset the gain, but you would have had less losses carried over as well. So they kind of go hand in hand. At which point you have to make a determination: does this cost segregation benefit me, will it because the key is to benefit you immediately. If you're accelerating depreciation, you want to use that right now. You're paying X amount of dollars for this cost segregation study. You want to get the benefit for it. If it's just being carried over, you're laying cash out now for what benefit? I guess it would all depend on the person's strategy and tax situation. But another little caveat with cost segregation is, as a result of the Tax Cuts and Jobs Act, the new tax law that passed, you can no longer, I only mention this because we were discussing 1031 exchanges, you can no longer, personal property, which is the portion that's broken out in a cost segregation. So, you said different buckets. You're having, assets that are being broken out from the real property into personal property. You can no longer 1031 exchange personal property. So only real property is able to be exchanged. So that's another component. What's the long-term play with the property? Can we exchange everything that we're breaking out here, if that's in the plans?
Oh, interesting. That's a significant thing. And again, I think that's I appreciate you pointing that out.
Sure.
Because that is essentially what you're doing in the segregation, correct? You're
Right.
itemizing the building into personal property.
Right.
Got it. Is that kind of in a nutshell the depreciation? In the different tax, the I guess the taxpayer classifications. Is that have we covered that, or is there something that that we should have gone into that we didn't?
Yeah, I mean that's definitely a good start.
Well, I'd say we could go really wide, but I was just going to say, as far as
Right.
just the different classifications and how depreciation is treated within the real estate transaction was kind of
Yeah,
what I thought would be
absolutely.
a
Absolutely. That's a great overview because, like I said, every tax situation and every individual and business is different. So the application of these principles are going to be different, regardless of who you're dealing with and who's investing and what their strategies are and goals are. But as an overview, sure, those are the basics. I guess I would say the one other thing that we could touch on is the real estate professional qualification, because that kind of is completely separate. And, that's going back to the discussion of losses, what you can do to qualify as a real estate professional.
Yeah, let's do that real quick if we could.
Sure. Yeah, just quickly,
Yeah.
just to touch back on the losses from the beginning of the conversation is, if you're a real estate professional, you can kind of bypass that passive loss deduction limitation. That $25,000 limitation, you can kind of bypass that, because if you qualify as a real estate professional, it's basically saying that this income is active. You're active in a real property trade or business as basically your full-time job. What to do to qualify? There's two qualifications. The first one is that more than half of your time has to be spent in real property trades or businesses. So if you have a full-time job, if you have a W-2, chances are you're immediately disqualified, because you have a full-time job. So your full-time is not in real estate related activities. And there are exclusions if you own, a portion of the business that you received a W-2 from, but I think that's beyond the scope of our discussion. So the first qualification is that over 50% of your time has to be spent in real property trades or businesses. The second is that you have to spend over 750 hours per year in real property trades or businesses in which you materially participate. And there's different ways to qualify as material participation. There's 7 tests, they call them. If you Google material participation 7 tests, you'll see what you can do to qualify as materially participating. So if you meet those two qualifications, you could qualify as a real estate professional. But I would just caution that it's definitely not a DIY, a do-it-yourself tax strategy. You should hire a professional, at least speak to a professional to make sure that you can qualify, because it is a highly auditable area. And the tax benefits are, if used correctly, are great. There are some downsides to it. So it's important to speak with somebody who's familiar with real estate investing and this qualification specifically, and if it could really benefit you, what the downsides are, and how it would work for you specifically.
No, I appreciate you going through that. I was listening to somebody the other day, and there was somebody that wanted to uh, claim that they were, and against their tax advisors, advice, they went ahead and did, and sure enough, they got audited, and
Yep.
they called the advisor for advice, and he said, "Look, I told you, you're not." So
Yeah.
I don't
Yeah,
know,
exactly.
you need an attorney. So,
Right.
um, but well, that's great. I appreciate you going back through that, because that is the one that we didn't really go through that much. But
Sure.
just as an overview, I feel like uh, the tax benefits and real estate are they're talked about a lot, but just to try and kind of narrow the conversation, I felt like this was kind of a nice way to kind of focus in and just talk about the differences between being the passive or the active. So I appreciate that.
Sure.
Um, Before we wrap up here, I want to shift gears. As I mentioned to you before we started the recording here, by day, I'm an insurance broker, and we deal with risk management daily. And there's a couple of strategies that we employ. We try to see, is there a way to avoid the risk? Can we minimize the risk? Or can we transfer the risk? Those are basically the three different strategies. And insurance is essentially a transfer mechanism, as are contracts. And so what I've been doing is I've been asking my guests, and I'd love to hear what your thoughts are. If you can identify what you see is the biggest risk real estate investors face.
Sure. Well, I guess I would go twofold. Well, real estate investor, I would say the biggest risk as a real estate investor myself that I would face would be failure to prepare. You know, if going into a deal, not analyzing it or not understanding the scope of the work involved, or understanding what level of time commitment, or cash commitment it's going to require from you is detrimental. So the biggest risk, yeah, I would say as an investor, the biggest risk would be, just if you didn't prepare. And I guess that goes without saying for other areas of investing or businesses too. But yeah, we've seen that cripple people in the past, and that would be the first one that comes to mind.
No, I think that's definitely a big one. Um, and definitely you mentioned the uh, what's needed and stuff, but even like capital, uh, working capital to be prepared to withstand any kind of
Yeah.
vacancy or cash shortage. That's definitely something I would think is
Yeah, yeah. A lot of
something
people
that's
get bogged down in the initial analysis, but then you don't budget going forward, and then it kind of it's a big risk.
right.
Yeah.
Um, well, great. I appreciate you taking the time to answer that. Um, Before we wrap up, where can the listeners go if they'd like to learn more or connect with you?
Best place to go is our website. It's aiolacpa.com. That's AIOLA CPA.com. You'll be able to find our social media handles, our blog, like you mentioned before, and just some more information about us.
Got it. Well, Nick, I want to say thanks for taking the time today to speak, and I've enjoyed it and learned a lot, and hope we can do it again soon.
Thanks, Darren. Yeah, looking forward to it.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.